Since last year, I could say around 38% increment in discovery calls where the subjects are more towards the rentvesting. The objective is very important.
Yeah.
You're doing rentvesting means objective is to making enough money in next 7 to 8 years.
Yeah.
So either you can sell everything and buy property on your choice suburb, or you can withdraw the equity. If you're enough borrowing, you can buy another property in your choice suburb.
There are 15,000 suburbs. So you are assuming then, you have to make an assumption that Brisbane is going to be the fastest growing suburb in the whole country, and the chance of that happening is very low.
Exactly, and then you need to have a right mix of assets also. That's why when you do a proper portfolio planning, you need to manage the cost.
Welcome to the Property Portfolio Podcast, where property, finance, and investing are broken down into real conversations, which have benefited thousands over the years. The show is hosted by leading industry experts who bring different strategies to the table. Parag Dixit, Chief Strategist of Infinity Financials and Prop Wealth, has more than 20 years in the financial industry and is consistently ranked among Australia's top 10 mortgage brokers. Rudit Kandawal, Director at Infinity Financials, has 2 decades of experience and over 200 5-star client reviews. He's known for helping clients build strong property portfolios. Julius, co-founder of Prop Wealth, has spent more than 15 years in real estate domain. He is a lead data researcher and has helped hundreds of people create wealth through property investment. Subscribe to the channel and get regular updates on what's happening in the property market.
The information in this podcast is of a general nature and does not constitute financial or legal advice. It has been prepared without taking into account your personal objectives or financial situation. Individuals must not rely on this information to make financial or investment decisions. You should seek independent professional advice before acting on any investment decisions.
All right. Hello, guys. How are you?
I'm doing very well. How have you been?
Good week. Coming closer to the end of this year. How have you been, Julius?
I'm doing good, thank you. It's a bit busy. Yeah, wrapping up few things.
Winding up,
If I'll go on holidays. So.
I know. What a year this has been. I think, this year, I think in my entire life, this year has gone the fastest. It's just flew past me. Before you realize, this year's gone. Yeah.
A lot happened. Yes.
A lot happened. Personally, I've traveled to from 4-5 countries this year, different countries. So every second month I've been traveling. Then there have been events within Australia. Then gone there. Then so much has happened in the property market, in the mortgage market, and rules changing. Investors ruling the first half. First home buyers now ruling from the last quarter or something. Oh, it's been a dramatic year. Very, very exciting.
Very exciting. No, I completely hear you and agree with you that the year started a little slow and there was slow movement in the market, not too much, but I think as the year progressed, last few months, and then especially after the introduction of the first home guarantee scheme, the expansion by the government on that just changed the market. And the biggest change, of course, the interest rate cuts. And there has been so much change around that itself. The year started, the rates started dropping, and then everybody was expecting there will be more rate cuts. Even till a month back, it was like there will be more rate cuts. But then suddenly now it's completely different. And now very, very high chances that the rates can go up, in fact, and the banks have already started increasing the rates. So the people I think it's been mind games between people, and they're like, what's happening and what's going to happen next? Keep guessing.
You're on the Gold Coast roller coaster.
Yeah.
These are changing like every day.
Every day.
You believe it? You were talking of I think in November or maybe late October, we were talking of 3 more rate cuts. Now we're talking of 2 rate rise. It's a joke now. The way economy is changing, nobody's to be blamed, but it's a weird thing.
And significant changes in property markets as well.
Yeah.
The start of the year was a bit slower, especially towards most of the capital cities, and then mid of the year was dramatic.
Yeah.
I could see around 15-20% growth in last 4 to 6 months.
Yeah.
And that is not normal. Even though the interest rates are not changing, still inventory is low.
Yeah.
And market has significant first home buyer and investors impact.
Yeah.
So next year would be different.
I'm very sure next year would be different. See, but again, I think next year is going to be even more challenging. I believe 2025 has been dramatic in that aspect that a lot of things had started stabilizing, though they still went in a sine wave or something, but still it started stabilizing. The market went into some direction. The preponement of first home buyer scheme did change it dramatically, but maybe it's a relief for us. Otherwise, you would have been working during Christmas period or something. But but it's still it's a bit of a different direction which it has taken from there. Especially, I suppose, the first home buyer schemes and the property limits which had got changed, that has been a dramatic game changer, because in a lot of cities now the properties are trying to come within reach. They're still not within reach. It's not a big change with respect to amount of money, but it's a psychological big change which is coming, and that's driving people to now start buying faster. I read somewhere yesterday or day before in the news. It was talking about that even lenders, I don't know which ones, but there are some lenders where their SLAs have blown out because they've got so many first home buyer applications. So it's a dynamic market. It's a super market.
No, absolutely right. And I remember, Julius, you were mentioning some time ago that how Perth market, for example, has changed, and then it was slow, and then it has bounced back. And so there are so many different, one on the finance side and then on the property side, it has been just a roller coaster, like you said.
Selected owner-occupied driven markets pricing in block size of $50,000 a month. Wow. That is what I could witness, like especially those suburbs which are more a choice suburb or more famous within the owner-occupied. It's very hard to find the properties there, and then owner-occupiers are motivated because of those schemes. Because 850K with that 5% have changed a lot of barriers for a lot of people, and there is more confidence in a buyer's level. And that confidence was required because Perth was historically the incomes are pretty good all the time. Plus, the inventory was extremely low. Only thing is you need that push. And after that scheme, they got that push, and then it's crazy now.
Yeah, that's true. And since I think that's what it has done. It's brought more confidence into first home buyers that I can get something which I like. But still, I think a vast population of first home buyers are not able to get something which they like to live in. Some matters of choices, some matters of compulsion because of various reasons. And I think that there's still a large number of people who can't reach where they would like to reach in the cities where they would like to reach. And that's still a long way to go before all first-home buyers.
You're absolutely right, Parag. And in fact, a lot more first-home buyers, first-time buyers, actually, I should say, they are looking at investing rather than buying the home they want to live in.
Oh, really?
The number of such people has increased significantly over the last few years. So more people are driven towards it, and especially because of affordability issues with the kind of property that they want to buy. Yeah. A dream home that you have in your mind, it takes much longer to save for the deposit despite the schemes. Then there's borrowing constraint. Then there are other things as well, where lifestyle, flexibility of how you want to. So I think a lot more people are looking at investing, rentvesting, and that's the common term, right? Yeah. We have spoken a lot of times about it. We do our webinars on that as well as what people are doing on rentvesting. But this year also, like last few years, the trend has been moving more towards that. But I think it's important to also keep in mind that rentvesting, although it is becoming more and more popular, a lot of people are talking about it. There's a lot of buzz around it. But then there are some things to keep in mind. That is it a good thing for you as a strategy, or what are things to be more cautious about? Yeah, I think that's something it's worth understanding that what does it take to get into this, and is it for me? Is it not for me?
So when you say that rentvesting, people have taken this up because of flexibility, right, or lifestyle. So I think that's where the issue, or maybe that's where the birth of rentvesting came up. Okay, I can't afford to buy what I want to buy, and hence I don't want to be away from the market as well. So hence I now get into something where I can afford to buy. I may not live in it, but at least I'm not out of the market.
Exactly.
And I hope that property increases. So whenever it increases, I take my value out, or I sell it, or do whatever, and then I'm able to do what I wanted to do in the short or the long run, right? That's where rentvesting came into account. But it brings flexibility. That's true. That's correct. Lifestyle. So when you talk of lifestyle, it means does it mean that it allows me to lead my lifestyle, or does it mean that I can choose to postpone my lifestyle later on?
So I think that's a good point. So by lifestyle, what I mean is that where I'm living currently, right? So let's say I've just moved in, or I've just moved out of parents' house, or just moved in, and I'm living on rent right now, right? So I choose a place where I want to live. That could be a choice of a suburb that I prefer this location because of it can be of various reasons, right? I want to live closer to the city, so I'm living there on rent, right? Or my kids, I want to send them to a certain school, and I like that school and the suburb for that school, so I want to live in that suburb. Or my friends live close by, I want to live close to them. Right.
Yeah.
I want to travel to office, and I want easy and fast commutation to commute to my office. I don't want to spend like hours driving to back and forth to the office. So these are some important decisions from a lifestyle perspective. Safety, neighborhood, right? The importance of the neighborhood, living close to water or whatever, right? So there are so many factors in our mind when we're looking to live in a specific location. And then of course the kind of property we want to live in, whether I want to live in a two bedroom kind of small villa, or I want a large backyard, so I want a detached big house, or I prefer living in a contained a strata environment where I don't have to take care of any of the
I don't want
to mow the lawn, right? So I would rather spend that time elsewhere. So the choice of all these factors is important from a lifestyle perspective. But the question then becomes is, now I want to live here. The kind of property I want to live in, the kind of place I want to live in, and that's my choice. But can I afford that? Should I be buying that, first of all? So one is, can I afford that? That is one question. And if I can't afford, then probably I can live on rent, right? Yeah. Now, but like you said,
I don't want to even commit. Maybe that's also something.
I don't want to commit. Yeah, but I don't want to commit right now because 3 years down, 5 years down, I may not want to live here. There are changes happening in my life. I will probably plan family. For a lot of people who are just married and they're yet to plan family, kids will come in, and then where do you want to live in? All these can change. So I don't want to commit to that. Yeah. So these are factors which are important. Affordability is important. How much savings do I have? Do I have the borrowing capacity? These become very important. And that's where the whole idea about, okay, I want to have this kind of property or this kind of house, but because of, I want to postpone that plan, not do it right now, and I will do it 5 years from now.
I think one of the key considerations like you put out is that I just don't have the savings. So I want to buy a house in an X area or an apartment in an X area, which I want to live in, and that was going to cost $1 million. So in Sydney, even if it's with a 5% scheme, you need about, say, 50,000 plus, you need about 40 grand in stamp duty. So you're close to 100 grand, right?
Yes.
I've just got 40 grand. I've got enough income to be able to get $1 million property, but just have 40 grand. What do? I can't buy it there. I can't buy the place where I want to buy. So sometimes the savings becomes a big roadblock. I just can't cross that. It's maybe the bank of mom and dad can come in there, but mostly it doesn't. And when it's not, that's where we get stuck. Or and another big one is borrowing capacity. I want to live in an X suburb. All my friends are there, or my family is there, but the property is going to come for $2 million there, and my borrowing takes me to $700,000. What do? I'm too far off. I'm just too far off. I can't reach there. So that's a big constraint when it comes to it.
Yeah, and there are a lot of people, it's a confusion about, okay, I'll buy something now because I can only afford that much.
Yeah.
And then try to get in the asset which is not exactly matching your lifestyle, but you are in FOMO, and then you have to buy something, and then people are trying to get into this type of asset.
Yeah, and classic confusion, right?
Classic confusion.
Do I buy now, or do I buy later? Do I buy something small and then I can upgrade myself later, or what do I do? There is too many things. Miss out on first time buy benefits.
Yes, that's a lot that is on people's mind. That there are, and the schemes are good, right? So stamp duty waiver up to a certain limit, and then 5% deposit. These are very good schemes. You can save somewhere between 20 to 40, 50 grand depending on what you're looking for. Not a small saving, but then the question is that if you're buying something to avail the benefits of the schemes, what are the things to keep in mind? Is that the right decision? Is there something that you're missing out on that? So that's the confusion in people's mind all the time. And we talk to so many people. That's where it comes on. What your goals are, what is your strategy, and how do you move forward?
Yeah, and it's not a great situation to be in where you want to really get into something, you really don't want to miss out, but you don't know what to do, and I think that's that bit of that bit of a fear of missing out has given birth to the Rentvesting as a phenomenon. People are taking up more and more to it. As a mortgage broker, I know maybe the number of conversations I would have had maybe in year 2024 versus the conversations I'm having in 2025. I think 25 must be more than double of what I've been doing in the previous year, and it's becoming more and more popular. It's becoming more and more prevalent, and it's becoming more and more important. But on the other side, when I talk to the first home buyers, they also have this thing. Okay, if I buy the investment today, or if I go into something today, will I miss out on the first home buyer schemes later on? Can I still avail that? Can I buy in a trust and avail that? Can I buy in my personal and still avail that? Can I buy a property in a different state but I still avail my first home buyers in benefits in my estate? There is a big fear of missing out, because you're right. It's very some schemes are very lucrative, very good, and why not get the benefit you can, and you're allowed to do that. It's a big fear. It's a big thing in mind.
Yeah, even though what I witness is when the amount of discovery calls which we are making nowadays since last 2 to 3 years, since last year I could say around 38% increment in discovery calls where the subjects are more towards the Rentvesting.
Yeah.
Because those who are either missing out on something where they can't buy here or they can't afford to buy here, or the borrowing capacity limitation, people are more aware about those type of terminology now, and then more and more investors would like to get into that shoe.
Yeah.
That they want to get into the investing where they can invest their money.
Yeah, I think you're right. So let's say pre-COVID or 7-8 years ago, this term people didn't even know about. This term was probably non-existent. Similar to like buyer's agent, they didn't exist that time, right? So lot lesser people knew about it. But today, the conversations, the number of people thinking about it is a lot more, and that's where the caution is very important. That yes, this strategy has worked for a lot of people. I know of a lot of clients. I'm sure you guys know of a lot of people who this has worked for them, and we should also talk about that. How does it work? But at the same time, it's important to know that and to understand that what are things to keep in mind, what are important factors, which whether it is suitable for you or not.
Absolutely correct. And see, the factors are important. The issues which come in front of you are important. The benefits which come into you in front of are important. But again, because we are living in a social media world, the biggest thing which comes and which catches somebody by surprise and which catches somebody by the confusion they get into is, I know I can't get into my first home now, but I also know that in 2 years this same property will be 10% higher or whatever high. So it will still be further away from me. So that capital growth, can I still capture it in some way or the other, that I'm not completely out of the market perpetually? So, I'm out of the market because of a 300K gap in my borrowing capacity.
Yep.
And my borrowing, if it doesn't increase too much, that gap is going to become 500K in 2 years. So it's going to keep on increasing. And that's my problem. I still want to be in there. And then we still find that there is a lot, and there is the popularity of property investment still drives people in and still creates that huge amount of FOMO, which as soon as new schemes come in, drives people up into buying properties, because you seeing in front of you, there's a tangible capital growth benefit which people can see has happened in few years. And I think property has been one of the key wealth creators in the last few years, and which drives people to that. And there would be many, many, many examples of people who have started small but have eventually gone ahead and achieved something which has been so strong, so nice, that they feel that, okay, I have been fairly rewarded with taking that path. And there are other ones as well who've not got the desired results, but I think there have been many happy stories, and that's why this movement has started off.
Yeah, I've worked with a lot of clients. When I speak to them initially, the discussions are around, I'm not able to buy in Sydney, and then I would like to buy in Sydney in future, but how?
Yeah.
And that's how we have to build the strategies around it.
Yeah.
So a lot of strategies are proven. Like we worked with a lot of investors where the borrowing capacities are around $300,000, $400,000.
Yeah.
And then amount of deposit they have is also limited. So around in 2020-21, when we have started talking to them, that time the borrowing would be around in between 500 and 600.
Yeah.
incomes are limited, only one person were working, but they hope that, okay, wife will start working and then they'll have more borrowing capacity. But at this time, I don't have I have very limited deposit.
Yeah.
So we have started investing them in a multiple cities across Australia, and not in Sydney because a lot of other states were accessible.
Yeah.
Started buying a property for them, and then in 3 to 4 years, their portfolio we have added at least around 4 to 5 properties.
All right.
So the entire equity growth is very close to around $600,000 to $700,000.
Oh,
So
wow.
now if you want to buy something in Sydney after 3-4 years, so it doesn't mean that Sydney's prices are stopped there.
Yeah.
But they have enough amount of deposit which they can use to go for the entire Sydney home. So for an example, if you'd like to buy $1+ million of property, they still have a $500,000 borrowing capacity. And then if they sell everything, they still have a $500,000 equity sitting in their account, which they can use towards their first home. So these are like classic examples of how we can achieve that from the Rentvesting examples.
Oh yeah, that's a good way to put it. So, what I pick up from you in such a nice way, you explain that. So I have bought a property in whatever time, and after some point of time, we know that the property's values have grown up. So in the last 6-7 years, the property which I would have bought 6 years ago has gone up by 60%, 70%, 80%. And now, but what I've also done is I was riding the wave. I bought some properties in some other states, and I was riding the wave, and my equity growth is giving me still the place where I would have been a few years ago, but in the house which I like. So I may still be at a 500, 600K kind of an equity position. So I withdraw that, I invest that into the owner occupier which I'm buying. I'm still at a $500,000 loan, but in the house, the kind of house I would have liked to be, which I could not have been at that point of time.
Exactly. And that's the beauty of the Rentvesting.
I think, you're right there. So especially like if you're not able to buy your dream house today, but you start small, that's the whole strategy about Rentvesting. You start small with a small property, it goes up in value. So instead of not investing, not taking any action and just waiting that, okay, I will buy my home 3 years, 4 years down, you can't just base it on hope that because property prices are going to go up. So Rentvesting strategy works in exactly that way, is that you invest that money in a high growth kind of scenario. You start with a small property, which is more in your budget, more in your borrowing capacity. It goes up in value. Use that equity, buy one more if possible. And then in the next few years, depending, again, it's not general for everybody, but yes, that's how broadly it works. And then use that equity, buy another, use that equity if you can buy another. And then eventually, although the dream home has gone up in value, but your equity growth will take you there. So that's how the Rentvesting strategy has worked for a lot of people. And that's where people want to be in, right? Now, in the process, what we have to realize that what to avoid and what to keep in mind, what could go wrong. And those are important things. And I think that's where we need to focus today on. Yeah.
Absolutely right. No, I think it's very easy to flow into the good examples. You know, we can always talk of X and a Y and a Z and a John and somebody else who's done good and who's made money and who's done this. And you can always hear these happy stories in the media from so many buyer agents or mortgage brokers or people who are in the various segments. But eventually we need to know what can go wrong. And there are even worse stories as well where people try to do that and people have failed. So it's not that it's only the good which has existed. A lot of bads has also existed here. So I remember so many clients who would jump into something just because they wanted to get a first home buyer benefit. And just because they wanted to get a first home buyer benefit, they would say, okay, my first home buyer benefit comes in this price range. So whatever comes in this price range, I will go and buy it.
Yep.
And when you go and buy something like this as an asset, there can be a number of wrongs which can happen when you're saying, okay, I will just buy. My borrowing capacity allows me to get $600,000. I think a few years ago, we still have that scheme, the first home owner's grant of 10 grand, which you can get in Sydney. So you had to buy something brand new within $600,000. So you would fit around your requirement into buying, say, I remember a client who bought a studio apartment in Parramatta, if I'm not wrong. And he had obviously him, wife and 2 kids. There was no way on earth they can stay in a studio apartment. It's a studio. So, but they bought a studio because that is what they could buy within 600,000 because they wanted the first home buyer, the first home owner's grant, plus the first home buyer benefit, plus obviously the stamp duty benefit. So eventually, for a $600,000 property, if I'm not wrong, they would have paid nothing more than $25,000 because 10 grand came from the first home owner.
And that 10 grand, 20 grand, the grant from the government, believe it or not, it has been so lucrative that it's like, free money? Why should I not take it, right? It's like when the government is giving free money, I have to take it. It's not whether it's the right thing or not, but you're absolutely right. People don't realize sometimes and miss out on that the kind of property or the kind of asset they're buying. $10,000 coming free money is good, but if the property you're buying, if that is not gonna keep pace with the market, then you might be under a lot of more money. I mean,
so it's a subpar asset. So see, the property is on its own is not bad. It's a studio apartment. It's made for a purpose. It's made for a bachelor to live in there, a flat or something like that. But as a family of 4, it's technically a subpar asset for you because it's not going to serve your purpose. You've gone into it to get some benefits and then you struggle in your daily life. And so that asset then puts you in a weaker position because you bought it for all the wrong reasons. You could not afford anything else. So you bought something which is not suiting you. And when it's not suiting you, you are now getting into trouble with something with that. And then you've got an asset which is not showing any capital growth. You've got an asset which is stuck where it is because it was purpose built for something else. It was not built for having a phenomenal capital growth. It was built for people to rent and live and work there.
I think what you're saying, Parag, is right. And I've seen that a lot of people make this choice of, they have that in mind that, okay, I am going to Rentvest, but I will buy this asset right now to get the first home buyer benefits.
Yeah.
So then you tend to buy it where you're living. You get the first home buyer benefits. And eventually people have that in mind. Okay, because the schemes are like mostly schemes are like you have to live in it for a year at least, and you can't rent out for a year. And people then think that, okay, after 1 year, I'll rent it out. I'll just put it on rent and I'll go on rent. So ultimately the objective is, okay, I'll move on rent and make this as an investment property. But because I'm getting first home buyer benefit, let me buy this property. A lot of people have done that. And the biggest challenge with that is because you're going for that scheme. Let's say if I'm living in Brisbane, then I will have to buy this property in Brisbane.
Yeah, in my backyard.
In my backyard. You have to buy in Brisbane because then only you get the benefits. But now the problem with that is, okay, you're taking it for the benefits, but then because ultimately you have investment in mind. But the challenge is, there are 15,000 suburbs. So you are assuming then, you have to make an assumption that Brisbane is going to be the fastest growing suburb in the whole country. And the chance of that happening is very low. That the city you are living in, that should be the fastest growing in the entire country. That's not going to happen.
That is where a lot of investors fail. That is what I've seen. Because research is the key. Every market across Australia will always run in the timings. And there is a market cycle timing which you have to follow. So as you say, like there are more than 15,000 suburbs. If you don't do your research properly, and if you're getting into the market where that market is already past their cycle, and the next cycle will be in next 4, 5, 6 years, then if you're buying that asset, it will not help you to build your generational wealth because you're not ready for the next one because the property is not growing. You already paid a highest price for that property. Or there are a lot of people who are trying to get the properties on the same street where that entire market is flattened out. And because of the excessive supply reason, the property market is not booming. So if the research is not correct, in that case, you will end up buying something which will not give you good capital growth or good cash flow. So that means you're stuck with the asset, which is not growing either. And then it is, even though too much of negative as well. So that research part is very complicated. And then that is where a lot of people are failing.
Absolutely. So you bought an asset, you bought into something because of an emotional thing or because just wanted to Rentvest as well, right? It's not only the first home purchase which is wrong. I wanted to Rentvest, so I didn't know. I had no experience. I had no professional advice. I didn't talk to anyone. I just thought, okay, I can buy for $500,000. So let me go on the map and wherever it is $500,000, let's say done, dusted. But that area didn't grow. That area doesn't grow. You don't get capital gains, capital growth benefits. You are in the negative. You have a high negative cash flow coming in from there. You don't know what government policies exist, what is changing in that state, how it is changing, how it is impacting, what kind of income which you can get from there. So all those issues get bypassed, and we've seen that being done by the first home buyers when they suddenly want to get into a rent vesting scenario, that I want to go there and I want to buy. And then you buy in one out of the 15,000 suburbs and into some property out there just for the price range, and then you make a mess of it. And it's a scary situation, because you don't buy assets. It's not a bag of chips, right? You don't buy assets just like that. You buy it's just, most people in their lifetime will buy maybe 1 or 2 or 3 houses.
Yeah.
That's it.
Yeah, and when you're buying a vacuum cleaner, which is $1,000, $500, right? People spend hours of research into it. They talk to their friends. They'll go on Google, check the reviews. They'll go to Good Guys and talk to the agent and ask them about everything. And they'll spend 5 hours on that. But when it comes to property, it's not $500. It's now $500,000. So it requires 1,000 times more research. So I can't focus more on how much research needs to be required.
Absolutely. In the sense that research is not only about the asset which you've got. So you bought an asset in an area, in an X area, but you've not only lost out there, but you lost out on opportunity cost as well, because there is another different area where if you would have known, or you could have got the research to back you, you would have been able to invest there and made much more money in capital growth versus this area where you've not gone ahead and bought something and now you're stuck. You just can't get out of it.
Yeah, the classic example of that opportunity cost is like a lot of people buy something which is going to settle in next 2 years.
Yeah.
And they're going to build it.
Yeah.
So you know that, okay, you have to do that. That means you're stuck with that asset. It will take for an example, you buy land. It is going to register in next 2 years. That means you can't buy anything else till that. And then there is a lot of uncertainty. After that, you have to wait for another years to build. That means you're losing the 2 to 3 years of period because of that one asset. That is like kind of very bad asset which you can choose. And you lose a lot on the opportunities.
Absolutely right. I think off the plan apartments or home and land construction, but typically off the plan, they've been good. A lot of people have got a great capital growth out there, but what it brings to you is a lot of uncertainty with it. And when first-home buyer would want to buy something in their own backyard, it's still easier because you can keep an eye on it. But if it's in a different state, you just don't know what's happening. If you buy it as an investment, you don't know what kind of an asset you've got into. You don't know when it will settle. So for 1 year, 2 years, you just can't do anything. You know that your budget is limited, so you can only afford to get this one. But then you realize that there are some fantastic opportunities which have come along the way, and you can't go in there. So it's a very cagey situation that you can't do much about, and it's not something which you can come out of it. So off the plan apartments have also been contributing to some of the huge mistakes rent investors have done while doing rent vesting when they are doing that, but where they didn't do the due diligence or didn't realize how long it's going to take for them to stabilize, or how long it's going to take for them to be able to actually get that property, and then it's gone. The time's gone.
Absolutely right. And this has come again and again. This is not one-off scenarios. I mean, you read media, you read news articles, and there are so many cases where people have lost out like that. And some of the risks to keep in mind are, there are inherent risks in off the plan, whether it's a unit or a house land or whatever, right? So inherent risks, developer related, financial risk. So I mean, there have been a lot of examples, developer related. What if the developer or builder goes bankrupt, right? So bankruptcy has been happening. It's not new. Last few years, you see the small, medium size, large, a lot of builders have gone bankrupt. But knowing and being aware of whether the builder you are choosing or the builder who's building that, what's the balance sheet like? How's the P&L statement? That's not easy for you to know. So that you will never know. Second risk is that there could be a lot of delays, and we have seen that a lot of examples where the projects have been delayed by not weeks or months, but like years. So you are living in that uncertainty also. When will your house get ready? And that's a lot of stress back of the mind as well. You've thought about that you're going to move in 6 months, but now it's going to take 1 more year. third is quality of construction. So what you have been shown is a promise, right? So you were shown some unit which was ready, and that's how your house will be, but your house is not ready yet. So whether it will be of the same quality or better quality, that's always a risk. And another builder side risk is that there could be escalation of price. So whatever, you can't make it 100% watertight, the contract. There will be always some clause there because of which a price rise, a fee escalation can happen. So you have to keep in mind that these are the risks you're taking. I'm not saying that these are not for everyone, okay? I as a person can choose that, okay, I have the risk appetite because I'm getting probably a 50 grand cheaper property because of this. But then I have to be aware that my risk, and I'm okay with these risks, right? So I think these are something that definitely to keep in mind.
Yeah, this comes in with home and land construction, where you know the land is going to register in some point of time in the future, and you are not able to, you don't really. You underestimate the costs which are getting into it. You underestimate the builder selection. You don't do the builder selection properly. And eventually, a lot of people who go into investments and want to invest in a different state in a home and land package or something, because the classic bit which comes in here is what I've realized in all these years is I have only 40 grand. But I know I will have a bonus coming in next year, and my partner will have a bonus coming in next year. I'm getting some money from somewhere. So I will have 100 grand next year. So let me buy a home and land package. I'm going to buy it in today's prices because I only need to put in 30 grand, 40 grand right now. So I do that. And later on when the money comes in, I'm running a huge financial risk because I don't know if it comes in or not. Assuming it goes right, it's good. If it doesn't go right, I'm in bigger trouble. But assuming it goes right, I buy an asset and I get into all these issues. I had underestimated the price. I had builder issues which come in, and that drives me into one of my worst mistakes which I have done. And this has come in the post-COVID environment. This has come to the front so many times with so many people where they got caught out.
And opportunity cost is a classic example too, because when you build a portfolio with a certain objective, that means it's a time-bound activity. If you're losing 2, 3, 4 years of good market cycle timing where you can invest somewhere which markets are growing, then you can actually make good money on your portfolio. But if that is restricting you,
then it's a problem.
Yeah, then only you have one asset, and you even don't know whether it will be growing or not.
Correct. Yeah, true.
And along with it, there are, so we're talking about the risk. Along with that comes the financial risk also, like you're saying, right? So my circumstances can change.
100%.
That is a possibility. Second is external market can change. There are, with the way the unemployments are changing, I mean, the rates are going up and the banks are changing their policies, the interest rates can change. We've seen that in recent past itself. So today, you imagine that, yes, you have the borrowing capacity to buy this, but 2 years from now, if the external market changes happen with your job, your employment, and suddenly you might be caught out. What do you do then? You are 10%, you have already committed to that property today. And in 2 years' time, if you're not able to settle that because of changes in financials, either yours or the larger policies and macroeconomic environment, then you're just caught out. What do you do? There's no recourse.
It has happened, right? Post-COVID, when there was an issue in the building industry and builders were going bankrupt like crazy. At that point of time, we had so many people who had booked lands, bought lands. Interest rates had risen like crazy when it had raised its 6%, 6.5% kind of a rates that we had reached. Borrowing was too short for people, very, very short. They just couldn't settle on the off-the-plan land which they had got, an apartment which they had got. They just couldn't get a loan for it. And so many people lost out on money. Builders helped a lot of people. I know a lot of people, they gave an extension. They did what they can to put some comfort around it. But eventually, so many people lost their deposits. So many people lost their money into it. Those are bad decisions which you have taken. Because maybe circumstances change it, but eventually when you go too far into the future and you don't know what's in front of you, as a rent investor, as somebody who's coming into the market for the first time, who doesn't have a plan B of what I'll do if this happens, they get really stuck into it.
Yes.
So, and then that may be either the greed or the lack of knowledge or the lack of opportunity or the lack of understanding the market. It hits you. Right? It's big time hits you, right?
And you hear this from a lot of people who have gone through this and who were stuck because of this, and then they come back and say, I don't know about the market, right? So it's important to understand the market, increase your knowledge based on that. Otherwise, if you're getting caught out like that, then you might be set back by 5 years, 10 years, and this as an asset itself might dent you so much that you're like, okay, I'm not going to get into this anymore. So you're losing out on opportunities which could have been yours.
Yeah. And see, I think if I also as a first home buyer, if I look at the other side, it's not only capital growth which drives me into it. It's also the lure of a good cash flow in a property which makes me make bad decisions,
Yeah.
That thought that, okay, this property is giving me a good rental income and that will help me boost my maybe borrowing capacity, or that will help me boost my normal everyday life. That is something which has so many times got us into the bad situation. Like you were talking, Julius, suburbs, you do a wrong suburb selection just because you thought cash flow is great and the property is going to give me a good rent, but eventually that property doesn't go anywhere in the few years.
It happened with a lot of investors. Like you look for a very heavy cash flow, select a suburb which is extremely regional, where you look at the gross yields, but when you actually look at the net, then they're very poor. So gross versus net difference is around 3 to 4% because of all the expenses, your higher council rates, insurances, and all the other miscellaneous expenses. And then you're missing out on the capital growth also.
Yeah.
So that could be the wrong asset selection by taking a decision that, okay, I would like to get into the property where the cash flow should be extremely good. Yes, you should look for a good cash flow, but your property should have a very good capital growth as well.
Yeah.
Or if you're looking only for the cash flow, then research of that suburb has to be pretty good. So at least you'll get the hybrid kind of situation.
Yeah.
Where the cash flow is also good, capital growth is also moderate, and then expenses towards the properties are not extremely high because you're not getting towards extremely super regional areas.
Yeah, so like what maybe this is because you don't really do a demand supply analysis there.
Yes.
You don't really understand what's the market dynamics playing in there. You just read some report somewhere and you buy that, and then eventually it leads you into getting into a poor situation where nothing much is going to come out of the property because it's a good cash flow. It may be super regional, very highly regional, but eventually you've got yourself into a place where it's going to be a poor outcome for you. For cash flow may be great, but capital growth is pretty low, and that's because I couldn't assess the risk which I carry by getting the property.
In fact, you're right. So the analysis of supply demand and a lot of other factors, but supply demand is more critical and not only the current supply demand, you also need to assess and look into a bit that what kind of supply is coming in the future. Sometimes what happens is that you see that it's good cash flow, but you don't understand that, okay, there's more supply coming and the rental which you're getting today, there's going to be a lot more supply coming in which will drive the rental down and the costs are not coming down. So it will eventually, your rental is also going to go down. So the cash flow that you are projecting in mind for the next 5 years is potentially go down. And of course, supply demand risk on the supply of properties and from a capital growth point of view, that's so critical. And that's where the whole building approvals and what kind of projects are coming there, that becomes important, very, very important to understand.
Yeah, super regional. That's the right word which Julius has used in what you're talking of supply demand. And you look at, okay, this area the rent is very good. You can get. The other day, I suppose we were talking of a property which has 10% rental yield, 11% rental yield coming from it. Pretty much quite into the regional areas, quite so much into the rural areas. But eventually what you're doing is you are buying into an asset which is not aligning with what you want to do. You as a rent investor, you are wanting to take some equity growth so that you are able to invest that or maybe sell that property and buy something which you want. Typical goals which most rent investors would have.
Yeah.
But I forget that goal and my goal becomes something else. And then after a few years, I'll realize, oh my God, what have I done? I really wanted that. And now the market where I wanted to be in has risen by $200,000 and I'm still there where I was. So actually I'm going worse off, right?
Exactly, because objective is very important.
Yeah.
You're doing reinvesting means objective is to making enough money in next 7 to 8 years.
Yeah.
So either you can sell everything and buy property on your choice suburb, or you can withdraw the equity. If you're enough borrowing, you can buy another property in your choice suburb.
Yeah.
But yes, if you pick up a wrong property, for the cash flow is not bad. Yeah. We need to have a certain cash flow, but they are right asset for the cash flow also.
Yeah.
So for example, if you go towards the good capital cities where if you can afford to get a house and granny flats or the good duplexes where Your capital growth possibility is extremely good. Your demand and supply analysis score is extremely good. Also, there would be very less employment concentration risk. If you're picking up this type of assets, then you should be fine. But picking up those type of assets where you're only looking at the cash flow, you end up with something where you have asset which is not grown, you're not meeting your objective, and you end up with something which is not correct.
And the risk can be so high. So if the property, I mean, like you're talking about, and we have seen those examples where there's a town which exists only because of, let's say, a mine, and you buy a property which because of 10%, like you're saying, right? But it's too good to be true, right? So there has to be that understanding of what risk is there. And there have been towns which have become ghost towns. So you use on paper, the rent seemed very good, the cash flow seemed very good, but then when the reality strikes, by that time it's too late. Now you can't exit because suddenly, within a short span, the property prices in that area might have crashed. So, not saying that this happens everywhere and every time and every town, but this assessment is important. And whatever you can gain in terms of knowledge before you invest here, it's important.
Absolutely right. So, Jin, you're right. And the assessment is very important. Assessment of not only the town and the suburb we're investing in. I think assessment starts from the goals, and the goals will lead you to which areas you invest, but they also lead you to what kind of a property I invest in. The people have gone ahead and bought their first property as a commercial property somewhere. People have gone ahead and bought NDIS properties. People have gone ahead and bought, some properties which just don't align with what they want to do. And then they get big time caught out.
Co-living is another flavor of the times, right? And you're absolutely right. So these are not saying that these are good properties, bad properties, because each property has to align with the objectives if you understand it, right? So yes, NDIS, there was a time when NDIS was more popular. It has, there have been policy changes and there have been changes in terms of how the demand is. What you need to understand about NDIS also is that what is the promise and what is the guarantee, and will it actually go for that? It seems very good on paper again, but if it is not rented out, then what happens? You are paid a premium for a property, because generally NDIS properties come at a premium because the promised rental rate is higher. But if it is not rented out, then what happens?
Yeah, generally NDIS properties, what I've seen is in the market, whatever the median price is, they are around $200,000 to $300,000 extra, because construction cost is also expensive. They have to follow certain guidelines and then compliance. And if you're not approved with that SDAs, or if you don't have full occupancies, then the promised rental yield on the paper versus what actually you're getting, that is very different. Also, you can't track the vacancy rate for the NDIS properties. In the normal properties, the normal residential properties, what are the vacancies for the rentals, and you can see that if the vacancies are pretty below 2%, you're okay, go there, you'll get good tenants. In NDIS, you don't know how many NDIS properties are coming there. There is no data to see the vacancies. That means higher the vacancies in NDIS, that means you're buying something where you're not sure about what is going to happen next. And then second thing is, you're not sure yet about the valuations also, because they are very expensive proposition. If you're buying something in that suburb, which is $200,000 or $300,000 above median price, then you'll be fall short on valuations as well.
Yeah, so it's a typical issues which investors get into when they buy complex products like an NDIS property or a co-living property or a rooming house and boarding house and all of these are more complex products which investors who understand what they do, understand the risk, what they can take care of, understand what they should get into or what they should not get into is kind of a thing which I think is too far ahead of the objectives of a rent investor to get into, to a first time investor to get into, or to someone who's pretty new into the market to get into, because they won't even be able to assess what it comes to, assess the risk which they get. Similarly, I've also seen, talking of construction, right? So we've also seen people who will join together with friends and they will say, okay, I want to buy a large land and I will subdivide and I'll make I make a duplex and you own one, I own one, or I've heard somebody who said I'll make 4 townhouses, 6 townhouses, and I'll sell them and I'll retain them. Or they'll go and say, okay, we can buy a land there and that land is coming cheaper and I can subdivide, without understanding that the council there doesn't allow subdivision. They won't understand the cost which come along with it. They won't understand the time frame it is going to take. They won't understand the holding cost which they will about to take. They won't understand the complexity of investing with a third party. It's a different thing investing with family. It's a different thing investing with friends, third party, because situations change, circumstances change, incomes change, realities change, and that brings disputes into it. So many examples of people who...
I think, Julius, you were sharing your own example, right? That your first time when you were looking to buy a land and with your friends.
Yeah.
Yeah.
Back in 2000, I believe 17 or 18, we got our acreage, and then 4 friends were together. We thought, okay, let's divide it, and everyone has...
You didn't buy it, right?
No,
you
we didn't buy it.
Yeah.
We were just thinking about it.
Yes.
And then luckily I got a good friend who is a builder. I just asked him to come and see. He said, okay, you can look at that land, but the biggest issue is who will lend you money for the earthwork. So in subdivision on paper, it's very, very, very easy. Like you draw lines and you make 4 blocks and okay, this is yours, this is mine. And then everything is hunky-dory. The biggest issue in the subdivision kind of properties of first is the assessment of whether that land has a proper permission from the council, whether you can subdivide, cost of subdivision, how can arrange those funds to subdivide, and when you do all the subdivision and all those activities, whether it is in your favor or not. Because you might pick up something in the market which is already available less than what you're going to spend onto the subdivision.
Yeah.
A lot of clients which I'm talking with, sometimes when they come up with the idea that, okay, can you get me something? Okay, we'll get a big land, and then, okay, they draw the lines on the paper. Okay, it should be big land. They should have a 3 or 4 meter side axis. As soon as we settle, we can subdivide and sell. It doesn't work like that.
Yeah, absolutely doesn't work like that. And this is poor knowledge of how councils work, how legal stuff works, how accounting stuff works, how all of these things put together is the impact of all of these things on the property. You don't understand. I know people who were friends, okay, they went ahead and set up a unit trust, and they said, okay, we 3 of us will come together and we'll buy this land, and then we'll subdivide this land, and you own one, you own one, you own one. All right, cool. You got a property, they bought the property. And then they went to the council, took them, I don't know how many months, and maybe a year or so, and they finally got a subdivision approval. Then they wanted to construct on it. In between, one person's circumstance changed, and they went from PAYG to self-employed, and so they were investing into their business. So he had no borrowing capacity, the other guys had borrowing capacities, and then there were conflicts about who's going to put in how much money, how will they construct 3 in a row, right? When you construct 3 in a row, there's a different skill, the different type of builders, you don't get every type, same type of builders.
Yeah.
So who owns the middle one? Because the middle one is the most impacted one. You can't build them like townhouses. So when you're building houses, you need to have gap between the walls. So if there is too less a gap between the walls, then there is a different set of lending rules which come into play. So, and the middle one suffers the most, because how do you go to your backyard? The only way you go from your house. Yeah. So all of these things started coming up with them. When it started coming up with them, they said, all right, okay, this is not working out for us. Let's go ahead and sell this land. So, and we'll go to the market to sell this land. Now, they didn't realize that the issues they are facing is the same issue which somebody else will also face. So who is going to buy the middle land?
Yeah.
So when they eventually when they finished up, and they did end up selling it, but eventually when they finished up, they realized that they made too small a money for all the stress which they took up. And they were all 3 friends. So 3 friends wanted to buy a first home, got misled into or misthought into about buying this and making money and doing this. You read that right on YouTube and Insta and all of these. It's just quick. It's just you could do that, subdivide and get in the flip and all that stuff and make money. But that doesn't work. You don't understand the legal stuff. You don't understand the associated costs. You don't understand what partnerships take. You don't understand how you will exit it. You don't understand GST rules around it. You don't understand most of this, and eventually you get caught out,
Yeah, in this case, at least, like you're saying, they made some little money, but there are so many cases where people have lost money in projects like this. And losing money is one thing, and I hope these guys are still friends. I'm not sure, but people have lost those relationships, those friends. So friends buying together, but because of disputes like this, the friendship, it's lost forever. So one is you lost money, you lost time, it was a lot of stress. You didn't make money out of it, and you lost your friendship also.
You don't have a house as well.
You don't.
Because you
You have nothing.
You wanted to start with owning houses, and the objective was to get them cheap, and that's fine. I relate to that. I also would want to buy it at an affordable price. Why not? And as a first home buyer or as a Rentvesting initial first time investor, the thing which you're short of is money, right? The thing which you're short of is deposit. The thing which you're short of is ideas to reach the kind of price you want to reach, and you make these. You get lured by this, and that's something which you have to resist, and have to always have a professional who can explain to you, okay, this is not the right path. This is the way you're going. If you're going to go there, you're very likely to fail. There would be a percentage who make money in this, but a large percentage who really don't make money in this, and they fall flat on their face.
Yeah, so I think, you're absolutely right. It's the onus on the professionals in the related industries like mortgage brokers, accountants, real estate agents, buyers agents, all of them together, that solicitors, right, to guide them in the right way. And at least people need to do their own research and be aware of, okay, I'm getting into this knowing that these are the risks, and I'm okay with these risks. These can go wrong, this can go right. I can make this much money, but there is a chance of losing that. And of course, having said that, having known how my risk ability is, I'm okay to take that. That's perfectly fine. But without that understanding,
Wow. Exactly. And as Parag rightly said, the flipping. It's getting too popular nowadays, but I've seen horrific examples about the flipping. That is something when you need to have a professional advice, because getting something for the flipping and then you calculate or they estimate something according to your limited knowledge, and that project could turn out into a nightmare. I've seen horrific examples. So unless you know how to do a lot of things, how to fix the things, how to take the codes, you can visit there, you can invest your time into that project, then you can make a little money. Or it will be a horrific project where you're going to lose money on the flipping.
Yeah, you need to have builder skills.
Builder skills.
And you need to have skills of getting all the trades together, and you need to have that coordination, project management skills, I suppose, to be able to do that. But you don't have that. But and it eventually leads to a poor outcome because you didn't have the full knowledge, right?
Probably you learn around 5-10 grand by spending around 7 to 8 months, or you end up losing money because when you estimate something and then you open that house, it could be anything. And then you can't ask your trades to stop because you have to finish it. So whatever the variation in the cost you have to pay.
Yeah, 100%. And you have to pay, and you don't realize how cost overruns can just go very quickly.
It could go either way.
Yeah, it can go either way, and it's you're right. It's a nightmare if you get into such situation. But okay, but the other side of it is the other bigger important side of it is getting too early into deciding about getting investment. So the three friends come together and they quickly decide very quickly on kind of maybe another emotional point where they have changed their mind from buying owner occupied together. Eventually they started off by saying, okay, we want to live next to each other. We are good friends, and we good friends as family, and we would love that the kids grow together. They're still friends, but you make mistakes. You don't blame others. You just make mistakes. So you wanted to do that. That was the noble intention. The intention was to go into their first house, but and that was always there. And but eventually you read through something and you get a temptation. Okay, I'll do this and I'll get into this, and you get too early into an investment. Okay, in 6 months my circumstances will change. I'll get a higher deposit, or my bank of mom and dad, they're going to lend me some money, but just wait out a few minutes or months, or the other situation where I can do something, and I could have maybe 6 months of a wait would have given me my own house. Like these guys, if they would have spent some more time, they would have bought one by one some houses in the neighborhood, and you get into there or something of the other sort. But eventually you were too early, and that's where the regret comes in. That's the reverse regret, right? May not be FOMO, I don't know what's the name for it, but that's the reverse regret which you get, that you got too early into something and now you missed out on some great first home buyer benefits, and now maybe your deposit is gone, whatever little you had or whatever large you had, or you're starting to fall short, or the borrowing is stuck now. You're in a worse cycle where you invested assuming, or maybe too early into it, just got drawn out into an emotional decision. Now you're in a fix. How do I come out of it? I can't buy my own house, and maybe you have different situation in your family.
Yeah, and that's how the assessment and then your strategy in place. So basically, if you have a clear goal and then you say, okay, in next 6 months my circumstances are going to be changed. Either I'm a self-employed and then I can make, according to my financials, okay, in next 6 to 1 month or 2 years down the line, okay, I can have a good borrowing capacity. If that is a limitation, but if I have enough deposit, they should wait or take a professional help.
Yeah, and in fact, like Parag, what you're saying is that is a very, very common scenario, especially when husband and wife could be on different pages altogether, right? So a lot of times I have spoken to couples who are looking for the first property, and one of them is more number focused and one of them is more focused on less emotional and more on the finance side.
Yeah.
So one of them is saying, okay, I want to buy something which will help me build wealth is my first priority, and the other one is saying, no, I want stability. I want to live in my own house. I don't want to look at from the numbers point of view. And you can sense that one of them is coming from this perspective, the other one is completely opposite, and they are not aligning together, and ultimately they go ahead and buy something based on one of them without getting both of them on the same page. And that's where situations like this is very common. And sometimes you're like, is it like, am I doing financial counseling or am I doing couple counseling here, right? So that happens a lot of times.
Absolutely right. And I think, to be fair to both of them, it's, you don't want to miss out on living in your own house, the freedom of living in your own house, the flexibility of living in your own house, but also you get scared by the barbecue stories and the friend stories and these stories, and then you say, okay, I don't want to miss out as well. Then you read media, you read all that stuff, and then you say, okay, I want to be there. Now this kind of a confusion always draws you into it. I always wonder, whenever first buyers, first time investors would come to me, what should be their approach? And I always felt that the approach should start from the goals. That's how you can solve this confusion of whether I invest or whether I get an owner occupied. Until I stick to my goals and objectives, I think it will be easier. That goals and objectives word, to make it work for me, to make Rentvesting work for someone, or to make Rentvesting work for me, that goals and objectives bit is very important before we jump into a Rentvesting bandwagon, or I keep myself to a first home buyer scenario.
I want to go to a destination, right? So I know where I have to go. And completely get it that it's not easy to set those goals because things keep changing. It's always dynamic, right? So and most of us can't look into 10 years down, 15 years down. So, but the more we can think about it right now, I think it helps, because then you know your goalpost, and the paths could be 5 different paths. And then, because which of those paths will be more suitable for you, that is where the whole analysis and whole understanding lies. So if you can look through a little bit more, talk to each other as couple and be on the same page, okay, let's do this first. And of course, 2 years down, your goal can change, which is also okay. But at least you have moved on a certain path with whatever you could understand and do the best given what information you have as of today.
So basically, you're talking of strategy, right? So I should have my goals. When I'm wanting to do Rentvesting, I should clearly have my goals. Why do I want to do this Rentvesting? And if I want to do Rentvesting, and if I want to invest into properties before I get into my first home, then I think one of the very important bits is my strategy of what will be my strategy. What number of properties will I need to buy to reach my equity goal if I am wanting to do that, so that I buy my first home, my dream home in the dream area or something. So whether I can fulfill this with one property or I will need 5 properties to do this, I really need to know that. I really need to know my risk assessment. Like we were talking about, you can get into risky stuff, or you don't know what you do, and you get into stuff which is not right. So how do I do my risk assessment? How do I really get into the property which is a desirable one? What is my exit point? That exit point is so important. I know my 2 properties will fulfill my goals. So I do that. I went ahead on that. But when do I exit? It always looks lucrative. Okay, if I wait a bit more, I'll get 20 grand more. If I wait a bit more, I'll get 50 grand more. But what's the point? What's the point where the good becomes the bad and the bad becomes the good? So where do I exit? How do I do that? What financials support me? So my financials take me to a point which is good, or my financials are now saying, okay, let's get out of this. My circumstances have changed, or my income objectives have changed, or I'm already reaching where I want to go, and I should like cut down my temptation and say, all right, I'm in a happy position, and I'm that dynamic risk assessment, the dynamic need assessment, the dynamic objective assessment. Okay, this was my objective. This is why I started on this journey as a rentvestor. I started on this journey with this X objective, and I'm going to keep a close eye on this. I don't want to miss out on this objective. And from a rentvestor, I just become just a property holder, just holding something, and I make a mess of it eventually. That's important, right?
Yeah, so the strategy of when you get into the investing, as we say, objective is important, and then you need to start buying the properties aligned to that objective.
Yeah.
So that's why you need to time the market.
Yeah.
What kind of property you need to buy, how much financial support do you have, and according to your financial assessment, what kind of property will suit your objective.
Yeah.
When to buy a high capital growth asset, when to buy the asset which will give you enough cash flow as well, because you have to balance your portfolio also.
Yeah.
Also the exit point. So what market we need to get in and when to exit that market. So whole research beat is very important.
I think, and we have detailed the whole capital growth versus cash flow in another podcast of ours, where for anybody who wants to understand more about what Julius is saying, that capital growth versus cash flow, what strategy suits you better, which one, or the hybrid, and in what kind of market scenario, what kind of context, which one makes more sense for you, that is very important, and you can listen to our podcast. Yeah.
So anyway, so coming back to it, when you're talking of the property, so is it even for a rentvestor or whether for an investor, the most important bit is location, right?
Yeah.
How do I research from the 16,000 suburbs which are there in Australia and find out which one do I go? So the location becomes true critical, like you rightly said, that there can be two objectives. Do I want a cash flow as an objective? Do I want a capital growth as an objective? So which location is going to give me what? And obviously, when I'm wanting to make a sustainable portfolio which can continue and hold on its own and not impact me in my personal life, then that location, whether it's a growth oriented location or is it just managing my portfolio by giving me a lot of cash flow input into it, that bit of a location importance is very critical in that.
Yeah, location. Property strategy should be locations specific to start with, because in the entire scenario, your entire objective is you have to exit somewhere, or you have to consolidate everything, and then you have to invest that into your owner occupier. So if that's the case, that means you need to make at least around 30-40% of the equity of your next choice house. How to make that? That means you need to have a capital growth. If you're getting into the suburb, the expectations of the capital growth or probability of data says, okay, you could get around 30-40% in next 2 to 3 years, then that will align with your objective. So right research with the right location and then right asset type is also important.
100%. Right research, right location, right asset type. All of these are going to lead me to a point where I will be able to decide, okay, what do I want to do? How do I want to do? I had started with an objective that in 5 years' time, I want to be in my choice suburb. And for my choice suburb, assuming that the property values rise at an X amount of time, I need $500,000 in equity growth at that point of time, for example. So if I am doing that, I need to know my path to doing that. I need to know what all costs I am going to incur when I'm going to reach there. So to buy a $1 million house or a $2 million house, then I'll need to have X amount of money for stamp duty. I'll need to have X amount of money for my deposit, which I have to put in. I may have to do an upgrade there. I may have to do a construction there. I may have to do a bit of a maintenance. I may want to do up the kitchen. I may need to do a lot of stuff. So whether I am able to pull in all of these things, I need to really understand what I want to get into. And to understand what I want to do 5 years down the line, I need to know how do I invest today. to be in my investment today should be aligning with my future of 5 years down the line of where I want it to go, and that will tell me what is going to be my strategy. That will tell me what is going to be the way I am going to approach investing into any of these areas. That's going to tell me what are going to be my ways of thinking, whether how do I assess my rental which is going to come in there, how do I assess, like you picked up at the start, gross rents versus net rents, right? Because in the end that is going to impact me whether I can hold it for a longer period of time. That's going to impact land tax, say in the states like Tasmania, states like Victoria. You'll have land tax issues which come in. So can I afford that? And can that be something which is going to be a showstopper for me for capital growth? All that bit comes in. How do I ensure that I am taking into account all of these things?
Correct.
So I'm not stuck into a bad portfolio and I miss out on the objective which I had for 5 years down the line. That's
Correct. Absolutely. Like you said, right, the cost, and then there could be negative gearing benefits, and there could be if you're in a certain locations, there could be higher insurance, there could be strata. So from a cash flow perspective, these become very important to understand. And because on paper, and then there could be, the property could be, let's say if it is not rented out for some time, you have to keep on, and property may require maintenance, so you have to keep buffer for some of these things before you say okay, and not get just happy about just seeing a number that the real estate agent is selling you there, right? So that this property that's a rental yield. So keep the buffers in mind, and your assessment of how cash flow will be for this property, and can you sustain that given what your financials are. That is very critical. Along the second important thing, I think there is also kind of property. Like we said, that many people, without knowing much about certain kinds of properties, whether we're talking about whether NDIS or commercial or co-living or getting into construction and subdivision and all. So an understanding of what your capability today is, how much knowledge do you have, what is the knowledge gap, how do you want to bridge it, that's very, very critical to the whole psyche of as an investor.
Exactly. And then you need to have a right mix of assets also. That's why when you do a proper portfolio planning, you need to manage the cost. Like a lot of investors I've seen, they're only trying, the assets are like, they are good cash flow assets with the good capital growth asset. But sometimes they try to buy all the assets which are extremely old. Like, okay, for every asset, the strategy is, okay, I will build granny flat at the back. I'll subdivide this land. That's what I'm buying that. And then it will come and so when you're buying those type of assets, right? Okay, old asset doesn't have any issue. But if you don't have mix of assets and all of your assets are older, and if started giving you a lot of maintenance cost, then your portfolio will be imbalanced. Because while you are generating good equity on the portfolio, you need to know how to sustain that portfolio. For that you need a cash flow. And these are the costs which can impact on your cash flow and then result in probably you have to liquidate the properties where that market is good. And if you can hold that property for another 2 years, then probably you can make 100,000 more. So that is very, very important, like what kind of asset you pick. And with every asset, you need to do cash flow analysis.
Absolutely right. Yeah, it's not about whether you want to buy a house and an apartment or a townhouse or something else or a duplex or something. But what's important is that asset. What kind of asset you're getting into? What's the quality of that asset? And more importantly, how it aligns with your goals, your objective. And I think one of my key takeaways from what we've been talking is that the first and the most important bit is the goals. I need to know my goals. Why am I wanting to get into rent investing altogether? Is it just because I'm hearing everyone do it, or is it because I want to reach to a conclusion? I want to reach to an objective, and that goal setting is such an important thing when we are doing rent investing that I can't emphasize more on that bit. That if I'm not having a goal, it's very, very likely that I am going to be very chaotic in what I want to achieve, and I may miss out on what I really actually wanted to do, whether as a person or whether as a family or whether as a set of friends and whatever it is, but I'm going to really miss out. And maybe I think also it's very important as a rent investor, and when we talk to them, from the basic questions of first home buyer schemes to understanding the buying process to understanding how do you really look at a property. I've spoken to first home buyers who don't even know how to read a contract, what kind of a contract can be. What is a contract? Do I sign an offer letter or do I sign the contract on the first time itself? So the basics are not known. So you need to really, really get in touch with professionals before you get into that. Whoever you trust, your accountant or your financial planner or your mortgage broker or your buyer agent or whoever you trust, it's important that there is a professional advice and a professional input which comes in to a first time buyer or a rent investor who is looking to get into that kind of a wanting to get into that field of rent investing. That's a very critical one, right?
No, 100% correct, Parag. And it is very important, like you said, the goal setting, the strategy for it, getting understanding and getting help from professionals, or of course talking to friends gives you a lot of information, but can't take away what a professional can add as a value. And a lot of times that basic financials and understanding of how the numbers will work out, that goes missing from, and it sometimes it becomes too emotional a buy. And keeping it very clear that whether it's these are the emotional reasons and these are the financial reasons, and making it clear in your mind that which of these are more important for you. How are you trading them off and making the decision for yourself?
Yeah, for me it's discipline also, because it's objective based scenario. You define your objective, and then in certain years, you know that you're going to reconsolidate everything, and then you're going to achieve your objective. So define your objective, stick to your objective, because in between you can change your mind and you say, okay, I want to buy my first home now. And then probably you'll not achieve your objective. So discipline is very important to achieve that objective. Take a right professional help, do a proper research, and then you need to do a risk assessment also. So if you can study about, okay, how to find the suburbs, what kind of suburb I need to get in, what kind of property, how much is my cash flow, and how to achieve my objective, and with the right discipline, it's very easy to do it.
Yeah, absolutely right. You need to understand about the financials. You need to understand about the investment environment. You need to understand about those states, about those areas. You need to understand about the cash flow coming in from there, the capital growth coming in from there, whether there's a growth in itself or not, and how do you exit? When do you exit? What's your exit plan? And even more important is how do you do your risk assessment about buying that property when you're starting your rent investing journey? It's very important to understand that holistic picture, and it should not be an emotional decision which a lot of times the first home buyers do, that they will jump into something without having too much of a knowledge, and that becomes an issue later on, right?
You're absolutely right. No, yeah, I think covered a lot. Yes.
I think we had a great discussion, guys. I think thank you so much for joining in. We've had a phenomenal discussion. It's such an eye opener about how you can get into rent investing and what's the goods and bads about it, right?
Yeah, absolutely. No, absolutely. Good to talk, guys. Yeah.
Thank you so much, guys. Thank you very much.
Okay.
See ya. Bye.
We hope you enjoyed the podcast. If you enjoyed being part of our community today, please take a moment to rate and review the show on your favorite platform.
We don't want conversation to end here. We're all active and ready to chat.
You can connect with each one of us directly via the links below. Thanks for watching. Keep listening. We have a lot of podcasts. Share your thoughts.